Hello, everyone. You are welcome to this online webinar. My name is Isaac Adekunle Obayemi. I'm the CEO of Jesimac Property and Investments in Lagos, Nigeria. So once again, I welcome to this particular lesson. Look at the first slide. The title is Capital Deployment in Volatile Markets, African Real Estate Dossier. The dossier is a collection of important documents. So this lesson is our institutional playbook, our advanced guide for investing in Nigeria and Ghana. So in lesson 2, we learn the names of the property types. Today we learn how to put money into them safely in markets that move up and down very fast. Please let's move on to slide 2. Moving beyond divination to execution. Look at slide 2. The heading says we are moving beyond divination to execution. Okay? So that means we are no longer just describing things, we are learning how to act. So the slides show 3 pillars, 3 big pressure that make generic investment checklists fail in Africa. So we are going to mention those pillars one by one. Pillar 1 on the left is currency volatility. So the value of Naira can change suddenly. So pillar 2 in the middle is infrastructure deficit. Roads, the power, water, all of these are not always there. So pillar 3 on the right side is title opacity. Land paper can be unclear. The lesson here is that you must tailor your analysis to survive history pressure. So please don't forget, I've mentioned those pillars that makes real estate difficult in Africa. Let me repeat the pillar again so that you can understand it. The first one, which I mentioned here, is volatility of the currency. Currency volatility is the major problem, while the second one is infrastructural deficit, while the third one is the title opacity. Please move on to slide 3. Residential real estate, the yield waterfall. Now let us talk about houses, which slide 3 actually discuss. So I call it the yield waterfall. Look at the diagram very well. Waterfall from the top and loses volume by the time it reaches the bottom. So this is how rental income works. The top is your gross yield, the headline number. But as you go down, money leak out. You pay service charge, you pay the agent who found the tenant, lose money when the house is empty between tenants. So bottom is the net yield, real money that reaches your pocket. Okay, so the advance inside here is that the spread gap between the top and the bottom is what truly matter rather. It's what truly matter in this case. So in Lagos, your headline yield might be 10 to 15%, but your net yield is often 3 to 5 points lower. So, and that's the case to study. Slide 4, please. Okay, so the 2 phases of residential return, you can see slide 4 is a table that shows the 2 phases of residential return. Look at the left side. This is the high grade estate, like a house in Lekki phase 1. The acquisition cost is 250 million naira. So the annual rent is 15 million naira. So the gross yield is only 6%. That looks small, but read the primary wealth driver. It is capital appreciation, the value of the land and the house itself that is going up by 15 to 20% every year. Now look at the right side. This is the high density flats, like a block of mini flats in Surulere. It costs 60 million naira to build. The annual rent is 8.4 million naira. Oh, good. The yield is 14%, and that is high. But the wealth driver is not just location, it is operational discipline. Depends on the property manager to collect rent and chase out bad tenants. So if the manager is weak, your 14% yield can disappear. That's just a fact. So we move on to slide 5, which I called residential due diligence and mitigation. Slide 5 gives us 2 warning gauges for residential property. Look at the warning gauge. One on the left, it is called tenant profile sustainability. Ask yourself, can the tenant truly afford this rent? A good rule is that the annual rent should not be more than 30% of the tenant's available income. So if the rent is too high, the tenant will soon default. Now look at warning gauge 2 on the right. It is the service charge trajectory. You must check the history of service charges in that estate. For the past 3 years, are the charges going up faster than normal prices? If yes, that is a silent drain in your pockets. Finally, look at the mitigation strategy at the bottom. Mandate is to use technology, use property management platform that track rent collection in real time. So this moves the human factor in handling cash and stop managerial incompetence. Okay, so let's move on to slide 6. Slide 6 has to do with commercial real estate. So analyzing lease structure. So it has to do with commercial property. This is about analyzing leases, contracts, tenants sign. Look at the table. It has 3 columns: office space, retail space, and industrial and logistic. Okay, so first, office space. The ideal lease used to be 5 years or more. That's for leases. Okay, so ideal lease used to be 5 years or more. So now look at the current reality. It has shrunk to 1 to 3 years because people work from home. So the modern strategy is to buy old office block like in Ikoyi, not for rent, but for the land underneath you plan to demolish and build luxury towers. So next is retail space. Fixed rent is going down. Now landlords use turnover clauses. This means the rent is linked to how much the shop sells. The strategy here is anchor tenancy. So the big supermarket like ShopRite is the sovereign. So if the anchor leaves, the small shop lose customer. So finally, industrial and logistic. This is the most resilient e-commerce companies sign leases for 7 to 10 years. Okay, so the strategy is to target gazetted free trade zone, like in Ogun State, where tenants get import duty waivers. Okay, so move on to slide 7. Commercial risk and rebalancing. So this is what slide 7 shows us, a critical red flag. Look at the image. It is called single tenant concentration risk. So this means one company is renting 70% of your whole building. Look at the trigger. That company's lease is ending in 6 months, and the impact is serious. Your building value will drop. You cannot sell it until you find a new tenant. The mitigation strategy is clear. Rebalance your commercial portfolio. Move away from traditional office spaces that depend on 1 or 2 big companies. Pivot toward medical and healthcare real estate like clinics and lab. And last mile industrial logistics like small warehouse near the city. I think that will be better for you. Let's move on to slide 8. Land banking, the infrastructure value S-curve. Slide 8 is about land banking. Look at the curve line on the graph. This is the infrastructure value S-curve. It shows how land value moves. It is not a smooth line going up. It's slow for a long time, then it shoots up fast, and then it slows down again. So the slide gives a case study. Dangote Refinery Corridor in Ibejuleki. In 2015, land was cheap, about 500,000 naira per plot. For years, nothing happened. Then around 2022, as the refinery got close to finishing, the price shot up to 8 million naira. Now, with the project done, traffic is heavy and prices have cooled. So the insight is at the bottom of the slide. Okay, sell into the hype and holding phase. That is 12 to 18 months before project completion. Do not sell the construction and gridlock phase after the project is finished. The money is made by exiting early. Okay, so slide 9. Land due diligence beyond title documents. Right? Try to get the facts. Slide 9 tells us that title documents are not enough for land. Look at the left side. It says physical verification, the seasonal inspection. Do not visit the land only in dry season when the ground is hard. Visit during the peak of the rainy season. The risk is that you might be buying a seasonal swamp. If you do, you will spend up to 30% of your building budget just filling the land with sand. Now look at the right side. This is Omonile Index. Talk to neighbors and local workers near the land. Ask if there is a history of local youth stopping constructions and demand settlement fee. So their local intelligence is more useful than government paper. The mitigation strategy is at the bottom. Inspect the land in person every quarter, and within 30 days of buying the land, erect a perimeter fence. This shows boundary dominance and prevent people from encroaching on your property. Alright, so we move on to slide 10. Slide 10 is about luxury property. The concept here is that luxury real estate acts as a parallel financial market instrument, and that means it is not just a house, it is a tool for storing wealth like a bank account in a foreign currency. Look at the chart on the right. It compares two assets. Asset A is priced in Naira, asset B is priced in US dollar. So over time, as Naira loses value against the dollar, asset A loses its global worth. The owner is suffering wealth erosion. Asset B keeps its full value. The insight on this slide is in bold. Okay, a Naira-dominated luxury asset is a wealth erosion event. So to protect wealth, you must think in dollars. Alright? Good. So let's move on to slide 11. The liquidity splits every time. That's a luxury typologies. So slide 11 continues the luxury discussion with a table on the liquidity splits. Look at the left column. Investment grade luxury. The profile is modern, minimalist architecture with professional security. Target is corporate CEO on rotation and diplomatic mission. So the liquidity, meaning how easily you can sell. Okay, that's the meaning of liquidity there. Is it high? Now look at the right column. Owners occupier trophy assets. These are highly customized ornate houses built to personal taste, like the older mansion in Banana Island. So the target is personal legacy use. So the liquidity is low because finding a buyer with the exact same taste is difficult. The mitigation strategy at the bottom gives a rule. For any asset value above 300,000 US dollar, you must mandate direct US dollar transaction. Never accept long-term fixed Naira 10 for luxury assets. So that is just a fact. Always make your transaction in dollars. Then we move on to slide 12. Slide 12 introduces off-plan risk. Okay, so some people call it the misallocation trap. So the heading say misallocation trap. The advanced metric is a cash to construction ratio. So the slide explains why off-plan projects fail. Some developers are undercapitalized, so they do not have enough of their own money. So they take your deposit and use it to pay for the land or their company overheads. So like salary and cash, then little money is left to actually build the structure. This is misallocation. Your money went to the wrong place. The trap is paying into a project that look good in a brochure. There has no money left for cement and steel. Okay, then you move on to slide 13. Off-plan due diligence framework. So slide 13 shows how to protect yourself. This is a 3-part framework. Look at part 1. Escrow validation. You need a tripartite escrow agreement. This is a contract between 3 people. You, the buyer, then the developer, and an independent escrow agent. Okay, like a reputable bank or law firm, the agent holds your money and releases it only when the developer reaches a building milestone. Part 2 is the 30% rule. If the developer asks for 40 or 30% of the price upfront, that's a red flag. It means they lack equity. A healthy project asks for closer to 30% or less initially. So part 3 is performance bond verification. Ask if an insurance company has guaranteed the project. So if the developer fails, the insurance pay you back or finishes the building. So this is how to escape off-plan framework or off-plan trap. So if you can follow those 3 advice,